Right, so let's say you want to get started with this investment thing. You have a little money laying around, or you have a stable monthly income. It's probably not enough to buy a house, and you may have heard in the news that if you had invested in Tesla or Apple 10 years ago, you might be a millionaire by now, or things like that. On the other hand, you know, investing can be risky, and you have probably heard stories from your parents or grandparents that they have once lost a lot of money in stocks in the financial crisis, or in other bubbles like the dot-com bubble, or in fraud stocks like Enron, and urge you to never invest. So this is my guide for beginners, and at the end of this you should be able to decide if you want to invest, take on some risk, or if you want to leave it. By the way, you will see timestamps in the video description so you can hop between chapters if you feel like. Let's first take a step back from investing and think about what happens to your money over time. Your money is guaranteed to lose value over time. Why is that? It's because of inflation. It really has become like a buzzword in the last few months and year, because the central banks has been printing so much money, and investors and people are afraid of globally rising inflation. But inflation has been basically here since forever, and it always has been between like 2 and 2.5% per year, and it's measured by how much certain goods increase by price each year, like food, rent, or gas. And so that means that all of your stuff that you want to buy increases roughly around 2% each year, which means your money is less valuable. Your money can buy less of this stuff. An evergreen example of this is a cup of coffee that cost around 25 cents in the 1970s and nowadays costs around $1.59. This is the perfect example for inflation. So if you have money laying around, the very first thing you should do is putting that in a savings account instead of a current account, because savings accounts usually have a little higher interest rates than normal accounts that you spend your money with. But still, the interest on these accounts are very low nowadays. They are hovering around 0.5% or lower, depending on where in the world you are. So that means over time you are still losing money, because 2% is the inflation rate. Your money loses value by 2%, but increases by 0.5%. That means it still decreases in value by 1.5% every year, and that's bad. So this brings us to point number 2. How can we stop our money from losing its value over time? It basically has to beat the inflation rate. So let's say the inflation rate is 2%. So we have to have an interest rate or yield or rate of return of more than 2%. As an example, let's say we have a savings account that returns you 10% of your money each year, which nowadays unfortunately is not happening. And illustrate this with a so-called compound interest calculator. If you've never heard of this, just type it into Google and play around with it yourself. Here you can see we can take a hypothetical $10,000 or euros or whatever that we have as an initial investment that we put in our 10% per year savings account. Then we can choose how many years we want to have it in that savings account. Let's say 10 years, and we can choose the interest rate. This is 10%. So you see, after 10 years, you will have more than doubled your investment. However, you might think 10% of 10,000 is just 1,000, and 1,000 times 10 years is 10,000. So that means at the end you would have exactly 20,000. But this is not how compound interest works. Compound interest works like that every year the return you get gets reinvested in your account. After 2 years you will have $12,100 and so on. But we have already clarified that a savings account with 10% does not exist, which leads us to point number 3. What is the key to making returns on your money? The principle behind getting some return on your money is to take on some kind of risk. Let's divide asset classes in risk-free asset classes and asset classes with risk. In the risk-free investment section, you basically only have the savings account and maybe government bonds, but they also have a very low interest rate at the moment. And you're basically guaranteed to get your money out of your savings account at any point of time. And you're also guaranteed to get some kind of return, which is marginal at the moment. On the other side, you have investments with some kind of risk involved, which is, for example, buying a house. You buy a house for, let's say, $100,000, and you get returns in form of rent payments each year, let's say around $10,000, which also gives you a 10% rate of return on your initial investment. And with that, you have your house paid off in 10 years. Let's also say the house increases in value by 50% over the 10 years. Then you have made an additional $50,000. The thing for starting investing in real estate is you either have to have a certain amount of money, usually a big amount of money, or a certain amount of credibility to get a loan from the bank. Also, there's usually a lot of effort involved in this. You have to find the right tenants, you have to furnish the house, you have to maintenance the real estate. In summary, it's not cheap, and you have to be there mostly and put in some form of effort. Also in the section where risk is involved are, for example, stocks or other investments like commodities. The beautiful thing about stocks is you can start with very little capital and you have basically no effort at all to keeping your stocks or any maintenance cost. So now that we know how to achieve higher returns, we go over into the section to what stocks are. I'll explain the risk part in a later section in depth again. Stocks are securities that represent a fractional ownership in a public traded company. In other words, if you own a stock of a company, you own a little tiny piece of the company. Let's take Apple as an example. Apple has around 16 billion shares outstanding. That's all the shares that Apple have and that are floating around in different accounts, and they're owned by certain people. And if you own one stock, you own like 0.000 something percent of Apple. How can I make money from stocks? There are basically two ways how you can make money from holding stocks. The first way are capital gains. Same as the house, stocks can increase in value over time, and a share of Apple that you bought in 2008 may have been worth around $10 to $20 and is now worth around $130. A capital gain is seen to be realized when you sell the stock, when you have the new amount of money in your bank account. The second way is the issuance of dividends. It's basically the distribution of earnings of a company to its shareholders. As an example, let's say Starbucks had a profit of around $1 billion in 2020, and the company decides that it wants to keep 50% and to reinvest in new stores, and 50% of the earnings should be distributed to all of its shareholders for being part of the company, for taking on the risk of being a shareholder of Starbucks. Let's also assume Starbucks has around 1 billion shares outstanding, which means that if you held one share of Starbucks, you would receive 50 cents for being a shareholder. Okay, that sounds all nice and great, but how do you actually buy a stock? Do you just go to apple.com into the store section and click on buy shares? No. What you need to have is a stockbroker. A stockbroker used to be a real person back in the days who was sitting somewhere at the stock exchange, let's say in New York, and you called him and let's say, hey, I want to buy 50 shares of Starbucks, and then he executed your order in his computer or on paper. Today, luckily, everything is online, and everyone who is above 18 or who has the consent of their parents is eligible to open an online stockbroker account. Every major bank in your country usually also offers you the option of opening an investment account. However, usually the interface of these brokerage accounts does not really look appealing, and the cost of buying and selling shares there is usually pretty high, and they usually also have costs just to run the brokerage. So depending in which country you are, I would just recommend you to look up an inexpensive online broker and choose the one with low fees and at best has a free interface that you can use. A bit annoyingly is that every country has kind of their own brokers. I also have 5 brokers for all kinds of different stuffs. But if you live in Germany or Austria, for beginners, I can really recommend you the app Trade Republic. It's a very easy to use broker with a user-friendly interface, and they only charge €1 per trade. The whole brokerage itself is free, which is one of the best offers you can get in Germany at the moment. If you decide to open a brokerage at Trade Republic, consider using the link in my video description, because then you will receive a €15 bonus in cash after you do your first trade there. Alright, now we know how to buy a stock, but which stocks do we actually buy? To decide in what stocks you should invest in, we should talk again about risk. What anybody wants is low risk and high returns. In any investment that is not risk-free, you could potentially lose all your money. Let's say you buy one house. Potentially that house could burn down and the land under it could also somehow become worthless and you lost all your money. I know the likelihood of it is very, very low, but it could happen, of course. But let's say you have 15 or 20 houses. How high is the likelihood that all of these houses at the same time, if they're not located just right next to each other, but in different cities, in different countries even maybe, burn down and the value goes to zero? This probability is very, very, very low. And what we're talking about here is diversification. You don't put all your eggs in the same basket. Exactly the same goes with the stocks. If you had put all your money in, let's say, Enron or Wirecard, and these stocks were going up, these stocks look great on paper, but then all of a sudden these companies were shown to be a fraud and their stock price went from essentially $100 to worthless or 50 cents and you lost all your money. Okay, let's say you invest in Apple. Yes, Apple will probably be here in 10 years from now, but nobody knows exactly. That's why as a beginner investor, you don't want to invest in individual shares. you're automatically exposing yourself to more risk. That's why there are a form of baskets of stocks called index funds. An index fund is designed to mimic the performance of a financial market index. In easy English, it's essentially an index that tracks a specific sector, for example, the technology sector, or a whole country like the United States, or even the whole world. The three most popular indices in the United States that you probably already heard of are the S&P 500, the Dow Jones, or the Nasdaq. In Germany, for example, we have the DAX, or in the UK, we have the FTSE. Okay, let's have a look at these index funds. As an example, let's take the S&P 500. The S&P 500 contains, as the name suggests, 500 companies, but not only some, the 500 most valuable companies in the United States. As we see, the index consists of around 6% of Apple, because it's the most valuable company in the US, around 5.5% of Microsoft, 4% of Amazon, and so on. How much percentage each company has in the index is determined by its market cap. The market cap is calculated by the number of outstanding shares times the share price. So in Apple's case, around 16 billion times $130. So if you were to invest in the S&P 500, your investment would be spread out around 500 companies, and for example, 6% of that would float into Apple stock. And the S&P 500 in general tracks basically the US economy because it consists of so many companies and the biggest ones, and it's a pretty good indicator of how the US economy is doing at the moment and how the expectations of the investors are, how the US economy will do in the future. What performance can you expect? Historically, the S&P 500 returned on average around 8% per year. Let's put this in our compound interest calculator. So let's take again our $10,000 and put it in as a one-time investment in the calculator. The length of time is 10 years and at an 8% interest rate or gain per year, which basically doubles our investment over 10 years. Okay, let's try something else. Let's say our time horizon is way higher. Let's say we want to retire by 60, we're now 20, so 40 years length of time, and we can contribute $300 to our investment each month, which would make you a millionaire by only investing $300 a month by 60. So the advantages of investing in an index fund is pretty clear. Each dollar you invest is automatically diversified into multiple companies, and if, let's say, one company or two companies out of 500 go bankrupt, that will not bother your performance that much. There is not only the S&P 500, there are also other indices and index funds, like for example a MSCI International Total ETF, which contains of over 4,300 companies. So this is considered a very, very diversified and low-risk stock market investment. Of course, this also comes with a disadvantage. The disadvantage there basically is that you cannot pick which stocks you're investing in because you're just investing in the index. So maybe you don't like some of the 4,300 companies. They will be in your portfolio, but also you cannot predict the future. So maybe in a few years, these companies are doing way better than you have expected at the moment. Now, in the last section, you heard of the word ETF, and I want to explain what this means. An ETF is a type of security that tracks the underlying performance of the index, like the S&P 500, and invests automatically in the underlying index. As an example, one of the most famous ETFs is the SPY ticker. That's the Spider S&P 500 Trust ETF. And you can basically imagine that it's like a computer. Whenever people invest or withdraw money, this computer automatically sells and buys the stocks of the index, equivalent to the percentage how much the companies are in the index. Because it's not a real person, but a machine who is allocating your money, the fees for this are very, very low. Like the fees for the SPY are around 0.09%, whereas yearly fees for actively managed ETFs can be north of 1%. This makes a huge difference in the long run if you pay basically zero fees or 1% every year in fees. It has also been proven to be very, very hard for actively managed funds to beat the overall market in the long run, and few funds were able to do it over a longer period of time. Warren Buffett famously made a bet in 2008 and bet against a hedge fund manager that the S&P would do better in the next 10 years than his hedge fund, and he won this bet. I can do a whole video about choosing the right ETF, the right tickers and stuff. If you want this video, let me know in the comments. So how and when should you get started? Basically, immediately. As you have seen in the compound interest calculator, the more years you have to invest, the higher return will eventually be. There's also the saying that time in the market beats timing the market, because you will maybe fear that the stock market is now at an all-time high. Maybe it will crash next week, next year, or in 5 years. Actually, nobody knows that. The only thing we know that in the long run, the productivity of humans increases. By that, companies' revenues and earnings also increase. Of course, a company can also do acquisition, mergers, and by that grow even faster than the productivity rate. But we essentially know that due to new technologies, now the digitalization or soon AI, the productivity will accelerate. There are also debt cycles, like the short-term and long-term debt cycles. So companies take on debt to increase their growth rate. I highly recommend you to watch the video How the Economic Machine Works by Ray Dalio if you essentially want to know how the whole economy basically works. I tell you learn more about economics in this video than in your whole high school time. However, before investing, you want to make sure that you have paid off all your personal debt, like credit cards, because here also interest occurs, but this interest is bad interest and goes against you. So you want to basically pay all that off before you start investing. You also don't want to invest with money you need in like the next 3 years, because there can be a market crash anytime. So if you want to make a down payment in 2 years for a house, don't use that money and don't invest that money. Just keep that money in a savings account. And you also want to make sure that you have an emergency fund. If anything happens to you, like you get ill or you lose your job, you have a 3 to 6 month emergency fund that is sitting at all times in cash in a savings account. After that, you're good to go. Just open a brokerage, as I told you. Look for a cheap and reliable brokerage which has good reviews, which has a lot of customers in your country, and make sure that they offer index funds or ETFs and potentially also monthly automatic investing. Then set it up and forget about it. A savings plan is particularly interesting if you really don't want to time the market at all, and if you just want to say, okay, I want to invest every month at a specific date, no matter how high or low the stock prices are at the moment, and that gives you like a dollar cost average. You sometimes buy when the stock prices are high, but you will also buy when they are low, like in the last crisis in 2020 or in 08, 09, and you will then perfectly track the index's performance. Okay, then at one point of time, you have most of your money invested in the stocks, but you actually want to buy stuff from it, or you want to go on a vacation or what, but when do you actually then sell your stocks? The answer is ideally never. That sounds harsh, right? Let me explain. The goal is to make investing a habit and to become financially free at some point in time. Financial freedom, what is that? I could do another whole video about that. Let me also know in the comments if you want to have a video about that. Essentially, you want to live off the earnings of your investments. In the chapters before, I told you that there are stocks that offer dividend payments, and there are also ETFs that combine all these dividend shares and offer then a dividend from all these shares to you. And basically, the older you get, the more you want to shift your strategy into dividend payment assets like dividend ETFs. And let's say you did good, you had a good job and you could invest like $600 a month, and with 60 years old you are there with $2 million in your investment account, and you have a dividend yield of 3.5%, which earns you $70,000 in passive income every year in cash to your bank account before taxes, and you have to do nothing for that. You don't even need to sell your shares, and that is basically the goal, to live off the earnings. For me, that's the absolute goal, not with 2 million, a little bit more would be nice. If you made it till the end of the video, congratulations, you can now officially start and open an online brokerage account and start investing in your first index fund ETF. I'm definitely gonna produce more beginner videos about stocks, but also advanced videos about stocks, so stay tuned for that. Good luck with investing. Hopefully see you in the next video. See you, bye bye.